Coming up on Business Incorporated. Eskom's biggest union demands 15% wage hike as power cuts worsen in South Africa. And Egypt launches its first digital business registry with Visa and CIB. And more from the spring meeting. The IMF says developing countries have to cut all subsidies to achieve savings and more. Hello and welcome to the program. I'm Ladi Williams. First off, let's check on the markets. Starting on the African continent, we see the NGX there managing to hold on, even though there's some kind of volatility in the market there. Was down about 0.01% last time I checked, but still trying to get into green territory at this point. South Africa's index up 0.52% at intraday. Other markets we track, we see the EGX also doing well, and Kenya closing down 0.36% yesterday. Move over to the Middle East now. We see Abu Dhabi. It's a mixed picture we have there in the UAE. Abu Dhabi index that's up about 0.10%, while the Dubai index that's down 0.26% at intraday today. Over to other markets we track. In the Middle East, we see Saudi Arabia also in positive territory, but the Qatari index holding on to that 10,000 level for the oil share index was down 1.33%. Let's see what's happening in Europe now. We see 1 week after headline-making China trip by French President Emmanuel Macron, Germany's Secretary of State is now in Beijing. Let's talk to Lars Holter right there in Berlin. Great to have you, Lars. So what's on the agenda during the state visit?
Yeah, thanks for having me. So Annalena Baerbock, the German Secretary of State, said on top of her agenda would be two political goals: to remind China of its responsibility to influence Russia to end its invasion of Ukraine, and also to send a clear message again that Europe sees any change in the status of Taiwan as unacceptable. That last topic was in the news again in recent days, and it's all about China threatening Taiwan with taking away that country's sovereignty. China, of course, sees Taiwan as a runaway province. In all this, the recent visit by French President Macron makes things more complicated because Macron has called on the European Union to reduce its dependence on the US in what some saw as a more dovish approach to China, and some have even called it a gift to Beijing, since Beijing would likely appreciate any tension in transatlantic relations.
Major trading partner for Germany and for most countries. How does trade play into the Secretary's visit?
Yeah, trade is a major issue indeed. Secretary Baerbock is generally more hawkish on China than, for example, Chancellor Olaf Scholz. She would like to reduce Germany's economic dependency on Beijing. Right before she left, the secretary said that she has no interest in an economic decoupling, but that she wants to have a, quote, more systematic look at the risks of one-sided dependencies and reduce them. Those one-sided dependencies have long been an issue. Germany and other trading partners have always complained that China as a trading partner doesn't work on a level playing field. China is a major investor, of course, in Europe, as it is in Africa and many other parts of the world. Just think of the investment China has made with its Silk Road project, investing in major infrastructure around the world and creating new dependencies everywhere. In turn, China does not allow the same investment by other countries within its own borders, and this uneven relationship will certainly be discussed once again. China's investment in Germany, by the way, has recently hit a bit of a road bump. Chinese shipping giant COSCO wanted to become a part owner of a terminal in the port of Hamburg. And while the German government initially greenlighted that deal, it is currently under review and might not happen after all.
All right, Lars, but markets also got some fresh trade numbers out of China. What do they look like?
Well, the numbers are pretty impressive. Exports in March shot up 14.8% from a year ago. But we should not forget that a year ago, China still had factories and ports shut because of the pandemic. So export numbers then were really, really low. Still, the latest numbers are strong, and they're mostly driven by strong shipments of solar panels, electric vehicles, and lithium batteries. All that is in high demand as large parts of the world invest heavily in e-mobility and the energy transition. transition. So it seems China is coming back with a roar, but analysts are saying that these kind of numbers are not sustainable in the long run.
Well, we'll definitely keep tracking those numbers. Thank you so much, as Lars Holter, right there in Berlin. All right, let's take a look at what's happening in the UK. We have reports of some retail earnings in the UK now. We have Juliana to give us those details. Great to have you, Juliana. So we see Tesco, the profits have fallen despite increase in sales, and the impact of higher prices looks like that's being felt at this time.
Absolutely right. Good afternoon, Laddie. As we see with most businesses in the UK, Tesco, which is the UK's largest supermarket by market share, has reported that operating profits are lower because of inflationary costs, skyrocketing high consumer demand, and just issues that they are facing with getting in key products into their stores. So it has slipped 6.9% year on year. I believe it came in at £2.63 billion. So they're still in very good shape. But of course, this is a fall from what they were reporting this time last year. So to the end of February 2022, I believe operating profits were at about £2.83 billion. Revenue is up. Revenue's up 7.2% to £65.7 billion. If you just have a look at these numbers, you can see why it is the UK's largest supermarket. And with all of that data, they've also offered their shareholders dividends worth about £500 million. And I think that's one of the reasons why Tesco at intraday is one of the biggest risers on the blue chip index. Of course, we know investors do love their dividends. But Tesco said that, look, it is hard. It's a very difficult situation in the UK at the moment, that they are going to continue what they've been doing in the previous week, which is to try and get the producers to reduce their prices, because that is one of the reasons why lots of shoppers are holding back, because it's just so expensive. We talk about CPI here in the UK being at 10.1%, but if you actually look, Laddie, at the retail data, it's so much higher than that. It's 17.1% according to Kantar, which analyses food numbers here in the UK. So it is really difficult. Tesco has dipped slightly, but they're still very, very healthy if you have a look closely at the numbers they released today.
And they've been able to reduce the price of milk. I guess that's going to help consumers somehow. But, analysts are focusing on what central bankers will do next with rates. The governor of the Bank of England, Andrew Bailey, has played down the risk of a system-wide banking crisis. It looks like more rate hikes are expected in the UK.
Yes and no. We're not sure. And I kind of feel like, depending on where you are economically, you'll have a look at what Andrew Bailey said and interpret it in a different way. He is, of course, the governor of the Bank of England. He has been speaking in Washington on the sidelines of the World Banking Group and the IMF's spring meeting. And of course, we know, as you just rightly pointed out, that central bankers are kind of under pressure to defend the fact that they've been hiking rates so aggressively. We were once, just about 12 months ago, at 0.1% in the UK, which was a historic low. We're now at about 4.5%. And there is a knock-on effect of that. The knock-on effect is that it costs more to borrow, and mortgage holders or anyone in this country that has a significant loan is noticing that their monthly payments are getting higher and higher. I think the most important aspect of the high interest rates is, of course, what we saw with Silicon Valley Bank. We had a bit of a panic a couple of weeks ago when, of course, not only did SVB collapse, we saw two other US lenders collapse, and then we also saw the forced sell of Credit Suisse. So what Andrew Bailey was throwing caution to is the fact that, look, even though we do think we are resilient, we have learned lessons from the 2008 financial crisis. We do have to realise that we're living in a very different society at the moment, and that's digital banking. He's, flying the red flag about digital banking, saying one of the issues that SVB had is that, of course, people were communicating so swiftly. And whereas before, in the 2008 financial crisis, if anyone cast their minds back, what you were seeing are queues of people outside of banks trying to get their money. You don't have to do that anymore. All you need to do is log into an app and you can take money away very quickly. So although he says that, yes, he does feel that things are resilient, there was a panic. We did think that perhaps what was happening in SVB would spread spread quite widely. It didn't. It was able to be self-contained. It was self-contained by the Swiss. It was self-contained by the Brits. It was self-contained by America. So he thinks that we are able to do that, but he is saying that because of our access to our funds so quickly, that measures do need to be in place to ensure that there is enough liquid, so mass deposits don't happen again.
Yeah, definitely don't need any run going forward. But how are the markets in the UK are reacting to the US Fed minutes from March, talking about a recession coming, due to the bank collapses in the US?
Yeah, pretty interesting, actually. I've just had a look at the data now, and we are in pretty good shape at the moment. The FTSE All-Share is up. It's up by 0.01%. The FTSE 100 is also up by 0.01%, but the FTSE 250, the domestic market, is down by 0.01%. Very much a lot of focus in the UK at the moment, Laddie, about that GDP data that was released earlier this morning from the Office for National Statistics, showing that the UK economy is basically flatline. Not great news when all we're hearing from the Chancellor, Jeremy Hunt, is that there should be optimism in the UK economy. Of course, this GDP data follows that gloomy outlook we received on Tuesday by the International Monetary Fund, saying that basically Britain is the worst performing G7 economy. Not great. The markets have picked up on that. In terms of the currencies market, the British pound is currently trading up against the US dollar, up by 0.12%. I think some of the comments from Andrew Bailey has creeped into the currencies market there. But the British pound is trading down against the euro at intraday by 0.05%, but up against the Japanese yen by almost 0.25% at intraday, Laddie.
And I'm hoping it's not because the dollar is kind of weak at this time. That's why we're seeing that gain. But thank you so much, Juliana. I'll see you tomorrow.
I think so.
Thank you.
Thank you.
All right, now let's take a look at what's happening in Asia. We see Asia-Pacific markets mostly lower today after minutes from the March Federal Open Market Committee meeting showed that Fed officials see the U.S. economy entering a recession. And look behind me there, we see it's Shanghai Composite. That's in the red, with the ASX 200 in Australia also in the red, 0.27%. Nikkei holding on 0.26%. And the HSI index there, 0.17% up, and the Kospi index 0.43% at 2,561 points. So it's a mixed sentiment we're getting in Asia. Moving on to the U.S. Now, see stock futures, they rose slightly today as investors weighed recession risk following the latest meeting minutes there. And see behind me, we see 0.03% marginal gain. That's what we're seeing for the Dow Jones Industrial Average futures. S&P 500 futures up 0.14%, and the tech-heavy NASDAQ holding on quite well, 0.33%, 12,994 points. Looking at how the markets actually close later today. And so the global oil market now, we see oil prices have retreated after rising for 2 sessions, with investors still showing lingering concern over the possible recession. If you look at Brent crude there, it's traded 19 cents, down 0.2% at $87.14 a barrel, while the U.S. WTI crude futures, that's still about 11 cents, about 0.1% to $83.15. Both benchmarks rose 2% yesterday to their highest in more than a month, as cooling U.S. inflation data spurred hopes the Federal Reserve is likely to stop hiking interest rates. Every investor looking out for guidance, forward guidance for those interest rate hikes. And we see gold prices, they actually rose today for the 3rd consecutive session, with the milder than expected U.S. inflation data prompting bets that the Federal Reserve might raise rates just once more before pausing. Spot gold, that was up by 0.6% to $2,026 per ounce. The U.S. gold futures, that rose 0.8% to $2,040.90. Gold prices rose over 1% yesterday after data showed the U.S. Consumer Price Index rose by 0.1% last month compared to expectations of 0.2%. All right, we'll take a break now. When we come back, commodities market update is next. Do stay with us. Welcome back. Still in the commodities market now. We see the domestic price of 25-liter gallon of palm oil has fallen by 28%, about $18,000 naira year to date. Meanwhile, one of the leading fast-moving consumer goods companies there has disclosed its gradual exit from the home care and skin cleansing markets, which affect 3 of its well-known brands. And that definitely is going to have a spillover effect for the markets. Let's talk to Victoria Mama, now analyst, FDC. Great to have you, Victoria.
Yeah, good afternoon, Maddie. Thank you for having me.
So what impact will this have on the domestic price of palm oil?
So first and foremost, I would just like to give a bit background on the domestic price of palm oil that fell, and I would attribute that to the seasonal factors. I mean, this is the period of abundant palm oil production because there is the seasonal period, the harvest period for palm oil, which is between March and May. So we have abundant supply of palm oil. That's why the price is down. So how would this affect the domestic price of palm oil? That is the cut down of production of detergents by Unilever. But I would not fail to let you know that palm oil is actually one of the ingredients that is being used to produce detergents. And Unilever as a company as a whole actually, accounts for or is a leading a leading demand business for palm oil globally. And of course, palm oil, which is regarded as an input for detergent production, once the company actually cut down on detergent production, it actually affects their demand for palm oil. So if the demand for palm oil actually falls, what happens to the price? It declines. And this would also be supported by, the harvest period, this seasonality, factors that would also bring the price of palm oil, down further.
Definitely, Nigeria used to be a big exporter, of palm oil, but that has dropped drastically. What would you say is responsible for that?
Well, it is true that Nigeria used to be one of the leading exporters of palm oil and producer of palm oil, actually, but that's the story has changed, and that is because of our low production of palm oil, domestically. It's not even enough to meet our domestic consumption, let alone, exporting to the global market. And although we have several, palm oil industries that have been, engaging in investment and backward integration to boost, palm oil production in the country. But it's important to note that those major players in the palm oil industry only, constitute less than 20% of local production. So it's not, sufficient to boost the local demand of palm oil, while the small-scale farmers actually constitute over 80% of local production of palm oil. And these small-scale farmers are actually being challenged, currently in terms of loan financing because they are, mostly being left out from loans and all of the borrowing scheme. There are also the issue of pot seedlings because we lack the research facilities to, take a look at the seedlings that are being imported into the country, and we find out that when those seedlings are planted, we put in so much resources into the seedlings and end up not getting the required output that we need. And then again, there are issues of poor farming techniques and the use of traditional processors to process palm oil, and this is weighing on the output of palm oil. All of this contributes to the declining level of palm oil production in the country, and has hindered the country from achieving or regaining the position as the leading producer of palm oil.
And definitely some African countries are already taking advantage of the AfCFTA deal there. But how can this help Nigeria to actually, come up with exporting more oil at this time?
Well, the African Free Trade Agreement actually provides that platform for African countries to bring in their products. It provides a market basically for African countries, to bring in their product and also for exports to the global market, actually. So this free trade agreement would actually, provide a platform for Nigeria, in terms of even investment, because of course we have the potential to provide palm oil, and it exposes us to investment opportunities, and then this would also, encourage employment opportunities, bring about employment opportunities, and as well as, support the growth of the economy in general.
We know the Economic Intelligence Unit there is expecting global palm oil production to grow further by about 4% to 80.5 million tons. How do you think this is going to impact the global price of palm oil?
Well, basically, production is expected to increase. Yeah, of course, we have major producers, Indonesia, Malaysia. They account for over 85% of global production, and it's expected that production in those countries would actually increase due to good weather condition. And then Indonesia actually placed an export ban, and there are plans to actually lift the ban in May this year. So that would also support the production prospect of palm oil. And when we have production, don't forget that the EIU actually, said that consumption will actually increase, but lower than the production. So when we have high production and low consumption, we have surplus. And when there is a surplus, it drives the prices of that particular commodity down. So high production, with maybe lower consumption actually would bring the price of global palm oil down, and this would positively affect countries like Nigeria that actually imports palm oil in terms of helping our foreign reserves and also supporting us generally.
Yeah, it'd be great to actually get more exports out at this time. But thank you so much, Victoria Mamo, analyst, Financial Derivatives Company. Thank you.
Thank you for having me.
All right, now let's move on to other stories now. See, the biggest labor union, South Africa's Eskom Holdings Limited, wants a 15% wage increase, even as the utility fails to generate adequate electricity to meet the country's needs, resulting in nationwide power cuts. The report, the National Union of Mine Workers wants the same pay rise for all workers, along with other increases in allowances for housing and other benefits. Solidarity, another labor union, the utility has also submitted its demands for a pay increase of 3 percentage points above the average inflation rate. South Africa's average inflation rate was 6.9% last year, and the central bank projects that will slow to 6% for 2023. And Egypt's Ministry of Supply partnered with Visa Inc. and Commercial International Bank to develop the country's first digital business registry and identification system. The new registry will provide each of Egypt's 4.3 million businesses with a unique QR code and digital identification card. The cards can be used for various transactions, including business license renewals, openings of new branches, and withdrawals from ATMs. The new system aims to boost Egypt's digital transformation and financial inclusion drive. Business registrations in the first quarter of 2023 increased 5% from a year earlier to 1.5 million. And the IMF says developing countries, including Egypt, have to reduce energy subsidies as the quickest way to achieve savings amid the ongoing global challenges and also amid the oil production reduction. And countries like Egypt and Nigeria advised to do away with subsidies to free up funds for developmental purposes. And giving more attention to the commodity exchange to boost Nigeria's agricultural value chain is a major adjustment in the revised capital market master plan. The chief economist of the Securities and Exchange Commission, Dr. Oke Umeno, highlighted this when he was a guest on Business Morning. Take a listen.
The revised master plan talks about how we will incubate. Because of it, we now have a regulatory incubator that we have set up, and the system would allow new companies, fintechs most likely, new startups to be able to enter the market and, make it more efficient. So that's one of the things. Another focus of the new master plan is the commodities end of the market, commodities segment. We all know that Nigeria does a lot in that. We depend on crude oil. We've got some good. We do a lot of agriculture. So it's important that we build a commodities market that will service these parts of our economy. It's not right that we have an economy that is based on commodities, yet we do not have a good market for those commodities. We have to have a way to do price discovery for our farmers. We have to have a way to provide financing for our miners and all that. And it's also important that we have standards for the products that we make. So this whole package is what we are doing in the commodities ecosystem. Another area of focus is the non-interest capital markets. We have a large pool of capital around the world and in the country. A lot of investors are interested in non-interest and ethical products. So we have created a whole section of that revised capital market master plan to focus on making these products available, making these opportunities available for everyone.
And that interview was definitely from Business Morning earlier today. Thank you so much for watching Business Incorporated. That's how your money performed at intraday. And those are the major stories on the African continent. Thank you for watching. I'm Ladi Williams. Bye for now.